The Sydney property market's continuing to rise for the fifth calendar year in a row, which is unprecedented growth. The question that many are asking now is how long can this continue? Today I've got with me Sydney's and Australia's best property expert in Louis Christopher of SQM Research. Louis, thanks for joining us.
Good to be here, Pete.
Thank you. Louis, how has the Sydney property market performed in 2016 year to date and the inner west specifically?
It's almost been a tale of two markets. So in the first half of the year, the market slowed down from the very fast and rapid rates of growth that we were having in 2015.
Yes.
You may recall if we go back to mid-2015, the market was rising at about 15 to 20% per annum. It was really a crazy time, if you recall. When APRA stepped in, that's the Australian Prudential Regulation Authority, mid-year last year to reining investor demand, the market slowed accordingly. And it kept slowing through to the first quarter of this year. Then starting from the second quarter, the market started to pick up a little again, particularly in the inner ring areas such as the inner west. And now where we stand, for my read on the market as we currently stand, is that the market is certainly accelerating. And when we look in the inner ring, it's accelerating quite rapidly. Once again, I would say the rate of growth now is running at a tempo of about 15%.
Can we expect APRA to step back in again, Louis?
If we continue to see very high auction clearance rates and that feeding through to very fast price growth on the official numbers, yes, we will see APRA step back in, or in a worst case scenario next year, potentially an interest rate rise from the RBA.
Wow, okay. Now there's a lot of talk about apartments. Do you see an apartment crash in the Sydney property market?
Not at this point in time, Peter. I know there's been a lot of talk about it. There's been a lot of fear about it. And we do know that there has been an increase in development activity. We know the numbers there, but the reason why I'm so sure that, look, no, we're not going to get a crash in Sydney is that the level of underlying demand has been accelerating. What I actually mean by that is that Sydney's population in the past 12 months has expanded by some 80 to 85,000 people. It's actually quite a lot of people.
And is that a spike or is that an annual average?
It's been slowly picking up. The average rate over the past 5 years has been along the lines of more about 75 to 80. The year before last it actually did touch 90. So very strong, and that means to meet that demand, you need to be building somewhere around 40,000 dwellings.
Right.
So when I look at the up and coming supply that's coming into the market, sure, it's elevated, but it's only meeting the underlying demand that's there at this point in time.
So your numbers are showing you there's no oversupply in apartments at the moment?
Not for the overall city.
Right.
Now, one caveat. Caveat being that there are certain pockets which we will see oversupply in. And those pockets look like to be the CBD, Green Square potentially, Kellyville out in Sydney's northwest. We're seeing oversupply pressure in those areas. They're starting to build up. But for the rest of Sydney, we're not really seeing it at all. And it's the reason why our vacancy rates in Sydney overall is still under 2%.
Sure, and so bureaucrats would be expecting that people would move into those oversupplied areas to soak up the oversupply in any case.
Yes, we're seeing that to an extent, but let's remember that not everybody wants to live in, say, a one-bedroom apartment in the middle of town. And that's the reason why we will still see pockets of oversupply, because what's being built isn't catering to the entire population.
Okay. And if I'm an investor in the market at the moment, would you advise chasing capital growth, yield, or staying out of the Sydney property market altogether?
Oh, tough question, Peter, because the reality is when I look at the valuation metrics of the Sydney housing market, the market's clearly overvalued. It's overvalued on most metrics except for servicing.
Right.
In other words, we are servicing our mortgages fairly comfortably, and the only reason why that has been happening is because of very low interest rates. But all other metrics that we've got is suggesting the market is well and truly overvalued, and probably the second most overvalued point since 2004.
So how long can an overvalued market sustain itself?
Yeah, probably until we see the next rise in interest rates.
Okay, so coming to that, what do you think would cause an interest rate rise and when?
Yeah, very good question, Peter. And yeah, quite frankly, I'm not an interest rate expert.
Sure.
But looking at what the money market suggests, the money markets are still actually pricing in a potential cut in interest rates next year. Now, I think they're wrong because I'm seeing some inflationary pressures build up, and I'm very sure once the Reserve Bank of Australia is fully aware of this acceleration in the Sydney housing market, they're very unlikely to cut rates. When we actually get a rate rise, though, it could be some time away. There's a lot of factors, a lot of X factors in the overall Australian economy and the global economy right now, which are suggesting that really there's not that much inflationary pressure. There's actually potentially the risk of deflation.
Yes.
And so there's every chance that central bankers and the RBA may not lift rates for a number of years.
Louis, we're agreeing that interest rates are likely to stay low for some time. So how much longer will the Sydney property market continue to rise in this fashion?
We believe the market's still likely to rise next year. And in all this, I've got a really good saying, Peter, and that is just like the stock market, property prices are never too high to go even higher,
Yes.
nor never too low to go even lower. And that's certainly the case right now for Sydney. The market is overvalued, as stated before, but I don't see any trigger yet in the market for the next downturn. Not yet anyway.
Very good. Louis, thanks for joining us today. We really appreciate it.
Good to be here, Peter.